The interest rate hiking cycle is officially dead, but a dangerous new liquidity trap is forming across housing and global trade.
Former Fed trader Joseph Wang and portfolio manager Mike Greene warned that while the ceiling is in, the floor is still being built. We've used AI to condense hours of their deep dive analysis into just minutes of actionable insights.
You'll also hear from Nick Gerli on the biggest housing reset since 2009 and Jeff Snider on the global recession warning coming out of Europe.
From the mindless robot driving tech stocks to infinite returns in real estate, let's get straight to the alpha.
Today we are breaking down insights from Joseph Wang, the former Fed trader who says the hiking cycle is officially dead after that 0.3% core CPI print.
Joseph points out that for the first time in months, the data actually surprised to the downside, which is a massive relief for the markets.
Wait, 0.3%? That sounds like a tiny number. Why is everyone throwing a party?
In the world of central banking, that is a huge win. It means the higher for longer mantra has a ceiling now.
But while the Fed is chilling, Joseph warns that the Treasury is about to flood the market with supply, which we'll dive into shortly. Joseph Wang's core thesis is that the Fed has moved from asking, how high do we need to go, to how long do we stay here?
Exactly. Jerome Powell essentially confirmed that the next move is unlikely to be a hike, which removes a huge tail risk for investors.
So they're just going to leave interest rates high and wait for things to break.
Not necessarily break, but Joseph suggests they want to see more good data before they even think about cutting.
It's a waiting game now, but the threat of a 6% interest rate is effectively off the table. Joseph Wang highlights that retail sales came in at a flat 0%. The consumer is finally feeling the pinch.
Right, if you exclude autos and gas, it's even worse. People are cutting back on discretionary spending.
Does 0% mean we stop buying stuff entirely?
It means compared to last month, there was no growth. When you factor in inflation, it's actually a decline in real volume.
So the high rates are finally doing what they were supposed to, cooling the economy. Joseph also notes a big shift in quantitative tightening. The Fed is slowing the runoff of treasuries from $60 billion to $25 billion a month.
That's a massive reduction. It's their way of ensuring the plumbing of the financial system doesn't seize up like it did in 2019.
Plumbing. Are we talking about pipes now or money?
Financial plumbing, the way cash moves between banks. If there's not enough grease or reserves, things get messy fast.
By slowing the drain, they're keeping the system liquid while the Treasury pumps out more debt. Joseph Wang is watching the Treasury's cash balance. They want to keep it around $850 billion.
To do that, they have to issue a ton of new debt. More supply of bonds usually means prices go down and yields go up.
Wait, so if the Treasury sells too many bonds, my mortgage rate goes up?
Indirectly, yes. Higher Treasury yields tend to pull everything else up with them.
It's a tug of war between the Fed cooling things down and the Treasury's massive borrowing needs. In Joseph's view, the 10-year yield is going to stay stuck in a range between 4.3 and 4.7%.
It makes sense. The cooling inflation keeps a lid on the top end, but the massive supply of bonds prevents yields from falling too far.
So we're just stuck? No big rallies or crashes?
For now, it's a consolidation phase. Boring for headlines, but important for stability.
Unless we get another hot inflation print, the spike to 5% fear is dead. Joseph is confident that the door is closed on further rate hikes for 2026.
He argues that the Fed would need a massive re-acceleration of inflation to change their minds, which isn't in the cards right now.
So can I finally go out and buy a car without a crazy interest rate?
Well, the rates aren't going down yet. They're just not going higher. You're still paying a premium.
Exactly. We're on a high plateau, not a downhill slide just yet. Joseph suggests keeping a close eye on bank reserves. If they drop below $3 trillion, things could get bumpy.
That's the red line for liquidity. If reserves vanish, the Fed might have to stop QT even faster.
3 trillion? That's a lot of zeros. Should I be checking the Fed's website every morning?
Just watch the 10-year yield. If it breaks out of that 4.7% range, it's a sign that the plumbing is leaking.
Basically, Joseph says to stay cautious. The ceiling is in, but the floor is still being built. The market is reeling from another gap down, and today we're breaking down the survival guide from Matt deWolf at Trade Brigade.
Matt is a pro at reading these pre-market price actions, and right now, his data shows the S&P 500 is testing levels we haven't seen in weeks.
Wait, another gap down? I feel like I just got used to the rally. Is the party actually over?
That's the big question. Matt's analysis suggests the alpha here is that we've broken the ascending channel and the risk of a 5 to 7% correction is spiking.
Exactly. While the bulls are hoping for a quick bounce, the technicals Matt is tracking tell a much darker story about momentum loss.
So basically, don't buy the dip just yet. I need to know if my tech stocks are going to zero.
Matt deWolf's core thesis is that the S&P 500 failing to hold 5,100 is a massive red flag.
Right, he's watching for a gap and go lower. If we don't fill that gap in the first 30 minutes, we could see a slide toward 5,000.
Hold on. What's a gap and go? Is that like a grab your bags and run type of thing?
Close. It means the market opens low and just keeps selling off without ever looking back.
And Matt notes that the volume on these moves is picking up, which usually means the big players are exiting.
Great. So the smart money is leaving, and I'm left holding the bag. Typical.
Matt deWolf is specifically worried about the QQQ. He's seeing major tech leaders losing their relative strength.
Exactly. Tech led us up, and according to Matt, it's now leading us down. We're seeing specific selling pressure in the semiconductors.
Wait, semis? Like the AI chips everyone was obsessed with? Is the AI bubble popping?
Matt wouldn't call it a pop just yet, but he sees a look above and fail pattern on the charts that is usually a harbinger of a deeper sell-off.
And when the QQQ drops 2% in a single pre-market session, it's hard to ignore the gravity.
So my tech-heavy portfolio is basically on a diet it didn't ask for.
One of Matt's key markers is the 50-day moving average. He says it's the line in the sand for the bulls.
If we close below that line, Matt thinks the floodgates open. We're talking a potential flush to the next major psychological level.
Line in the sand? More like line in the quicksand. What happens if we sink?
Then we start looking at a transition from a buy the dip market to a sell the rip market.
Matt deWolf's data shows that every time we've tested this recently, the bounces are getting weaker and weaker.
So the rip is just a chance for people to escape before the next drop.
Precisely. Matt is urging caution until a clear reversal pattern prints.
Matt deWolf's primary prediction. A failed bounce today leads to a retest of 4,950 on the S&P.
His reasoning is based on the lack of buyers at these higher levels. If the opening range breaks lower, that target becomes a magnet.
Retest. That sounds like the market is taking a makeup exam. It's definitely going to fail.
It's about finding where the real value is. Matt believes the market needs to wash out the weak hands before a real rally can start.
And that washout could be painful for anyone jumping in too early.
So, I should probably keep my hands in my pockets for now, right?
On the flip side, Matt says if we reclaim 5,120, we could see a massive short squeeze.
Exactly. All the people betting on the crash would have to buy back their positions, which would launch the market back up.
Wait, so if everyone thinks it's going down, it might actually go up. My brain hurts.
That's the beauty of market mechanics. Matt's point is that we need to react to the levels, not our feelings.
Right? And until Matt deWolf sees that specific level hold, he's staying defensive.
Okay, so 5120 is the magic number. I'll write that one down.
Matt deWolf's top takeaway is to wait for the 15-minute opening range to set before placing any trades.
It's the safest way to avoid the chainsaw volatility at the bell. If it breaks the low of that range, stay out or go short.
15 minutes? I can barely finish my coffee in 15 minutes. I can wait that long.
It's about discipline. Matt suggests keeping an eye on the VIX as well. If it spikes over 20, volatility is officially in charge.
And if the VIX is screaming, your position sizes should be screamingly small.
Got it. Small bets. Wait 15 minutes and watch Matt's levels. I think I can handle that.
Today we're breaking down Nick Gerli's latest warning. He says we are witnessing the biggest housing market reset since 2009.
It's a bold claim, but Nick points to the National Association of Home Builders data showing a massive disconnect between supply and demand.
Wait, 2009? Like the actual Great Recession? Are we really back there already?
In terms of builder confidence and inventory levels, Nick argues the numbers are starting to look identical.
And while new homes are hitting a wall, there is a hidden trap in the existing home market we'll uncover in a minute. Nick Gerli highlights that the NAHB confidence index has slipped into the low 40 range, which historically signals a major contraction.
Exactly. Anything below 50 means more builders are pessimistic than optimistic. They can't move these houses.
So if the builders are scared, does that mean they're going to stop building or just drop the prices?
Both. But right now they're stuck with finished houses that nobody can afford at 8% mortgage rates.
Nick says this is the first domino to fall in a much larger correction. According to Nick Gerli, 32% of builders are now slashing prices just to get people in the door.
And that on top of massive incentives like mortgage rate buy-downs, which aren't even reflected in the list price.
Hold on, a buy-down? Is that like a discount or just a gimmick?
It's real money. They're paying the bank to give you a 5% rate when the market is at 7%. It's a huge hidden price cut.
Nick's point is that if you add those incentives to the price cuts, the real value of new homes is dropping fast.
The data Nick shared shows new home inventory hitting over 9 months of supply, which is well above the healthy 6-month mark.
That's a massive glut. In some regions, Nick notes it's even higher, creating a buyer's strike scenario.
Right, 9 months. So if 0 houses were built starting today, it would still take that long to sell what's already there.
Precisely. That oversupply is what eventually forces prices down across the board.
Nick suggests this is why builders are in liquidation mode in certain Sunbelt states. Nick Gerli also flagged a rising cancellation rate, where buyers are literally walking away from their deposits.
When the home's value drops during construction or the rate jumps, people decide losing a $10,000 deposit is cheaper than a bad loan.
Wait, so people are just leaving their money on the table and running away?
It happens more than you think. Nick points out that this adds even more ghost inventory back onto the market.
And when those ghost homes hit the market, they're listed at even lower prices, fueling the downward spiral.
Nick predicts that the Sunbelt, places like Florida and Texas, could see price drops of 10 to 15% in the near future.
He's basing that on the sheer volume of new permits. Those areas were overbuilt during the pandemic boom.
Wait, I thought everyone was moving to Florida. Wouldn't that keep prices high?
People are moving, but the supply of new homes being finished right now is simply growing faster than the population.
And as Nick warns, when the supply is too high, the migration story can't save the price tag. A key prediction from Nick Gerli is that existing home sellers will eventually be forced to compete with builder discounts.
Right now, existing owners are locked in with low rates, but as soon as they have to sell, they'll find their neighbor's brand new build is cheaper.
So basically, the new homes are going to pull the rug out from under the regular homeowners.
Exactly. You can't sell a 20-year-old house for more than a shiny new one with a subsidized mortgage rate.
Nick calls this the spillover effect, and it's how a builder crash becomes a total market crash. Nick's main advice? Keep a close eye on the months of supply in your specific zip code.
If it climbs above 7 or 8 months, that's when you start to have real leverage as a buyer.
So I should just wait until the chart goes up and then lowball the builders.
That is exactly what Nick Gerli's data is suggesting. Patience is currently your best asset.
Also, Nick reminds us to look at the net price. If they give you $50,000 in upgrades and a low rate, the house is effectively much cheaper than listed.
Okay, so the sticker price is basically a lie right now.
Pretty much. As Nick Gerli's analysis proves, the housing reset is here. You just have to know where to look.
Keep your eyes on those builder permits. That's the real leading indicator.
Today we're dissecting Jeff Snider's latest analysis from Eurodollar University. And the lead is buried deep. Europe just sent a massive warning that the global economy is stalling.
Right. Jeff points out that while the headline Eurozone GDP printed at 0.4%, that number is a total mirage once you look under the hood.
Wait, 0.4% sounds tiny anyway. Are you saying it's actually worse than that?
Exactly. Jeff Snider argues that if you strip out the Irish distortion, the real growth for the bloc was actually closer to 0.2%.
The real alpha here is that Europe isn't just having a bad quarter. Jeff believes they are the canary in the coal mine for a global recession the U.S. hasn't felt yet.
And while the U.S. looks okay for now, Jeff warns that the data shows a massive risk for global trade, which we'll discuss in just a minute.
So basically, Europe is the trailer for a horror movie that's coming to a theater near us.
That's exactly how Jeff Snider sees it. If the Eurozone falls, the global demand engine dies with it. Jeff Snider's thesis is simple. The soft landing narrative is a fantasy fueled by bad accounting.
He highlights that Ireland's GDP surged by 2%, which sounds great until you realize it's just multinational corporations moving money around.
Hold on. So if Ireland didn't move their spreadsheets around, the whole of Europe would be flatlining.
Basically, Jeff notes that without that boost, the growth is a pathetic 0.2%. Jeff Snider focuses heavily on Germany, the engine of Europe, and the news there is grim.
The manufacturing PMI is stuck at 40.6. Anything below 50 is a contraction, so 40 is basically a depression for factories.
40.6. That sounds like the economy is in the ICU.
It is. Jeff points out that German industrial production is down significantly and there's no sign of a rebound.
What's weird is that energy prices have actually come down, but the factories aren't starting back up.
According to Jeff, that's because the problem isn't supply anymore, it's demand. Nobody is buying.
So if the world stops buying German cars and machines, Germany just stops?
That's the fear. Jeff Snider calls this a structural decline that can't be fixed by just lowering interest rates.
Jeff also cites consumer confidence data, which is hovering at levels usually seen during the Great Financial Crisis.
In France, the index is still well below the long-term average of 100, currently sitting in the low 90s.
So people are too scared to spend because they think they might lose their jobs.
Exactly, it's a psychological trap. Jeff argues that this lack of confidence is what turns a slowdown into a recession. Looking ahead, Jeff Snider predicts the European Central Bank will have to pivot faster than anyone expects.
He thinks they'll be cutting rates aggressively to try and catch a falling knife, but it might be too late.
Wait, if they cut rates, doesn't that usually fix things?
Jeff says no. When the problem is a lack of global demand, cheaper loans don't magically make customers reappear.
Jeff's second big prediction is that the US won't stay an island of growth for long.
As Europe stops buying, US exports will take a hit. We're already seeing it in some of the regional Fed surveys.
So the soft landing in America is basically dependent on Europe not imploding.
Pretty much. And Jeff Snider's data says the implosion is already underway.
So what do we actually watch to see if Jeff Snider is right?
Watch the German 10-year bund yields. If they start plummeting, it means big money is fleeing for safety.
Bund yields. Got it. If they go down, it's time to worry about my stocks.
Exactly. It's the market's way of saying recession is here. Jeff also suggests keeping a hawk eye on the global PMI reports.
If the worldwide average drops below 50, the global recession is no longer a warning, it's a reality.
50 is the magic number. Under 50, I'm locking my wallet.
Probably a smart move according to Jeff Snider's playbook.
Today we are analyzing a deep dive between Adam Taggart and Mike Greene about the massive force driving our markets, what Mike calls the Giant Mindless Robot.
Mike Greene is a portfolio manager who specializes in how market structure and passive investing actually move the needle, and he's sounding the alarm.
Wait, a giant mindless robot? Is this a sci-fi movie or my retirement account we're talking about?
According to Mike, it's both. He's referring to the mechanical nature of passive index funds that buy stocks regardless of their value.
In his discussion with Adam Taggart, Mike highlights that this robot is finally starting to lose its grip as the macro environment shifts.
So the thing that's been pushing my 401k up for 10 years is finally getting tired.
That's exactly what Mike Greene is suggesting. If the flows stop, the buying stops.
And when the buying stops in a market dominated by robots, things can get very ugly, very fast.
Mike Greene points out a staggering statistic. Passive investing now accounts for more than 40% of the entire US market.
And because these funds buy no matter what, it creates a feedback loop that pushes prices to extremes.
40%. So almost half the market is just on autopilot with no one at the wheel.
Precisely. Mike's thesis is that this mechanical buying has reached a saturation point.
Which means the market is no longer reflecting reality. It's just reflecting where the next paycheck goes.
That sounds incredibly fragile. What happens if people stop sending those paychecks?
One of the big red flags Mike Greene mentioned to Adam Taggart is the labor market. Have you seen the recent unemployment numbers?
He notes that unemployment has climbed from 3.4% to 4.3%, which triggers the SOM rule, a historically perfect recession indicator.
The SOM rule? Is that like the law of gravity for economists?
Pretty much. Mike explains that once unemployment starts rising this much, it tends to keep going because of reduced spending.
And Mike warns that the Federal Reserve is already behind the curve in reacting to this shift.
So the Fed is basically trying to put out a fire with a squirt gun right now.
Mike Greene also highlighted the recent chaos in Japan. That yen carry trade unwind was a massive shock.
He described it as essentially a $6 trillion global margin call that forced investors to sell whatever they could.
Wait, 6 trillion with a T. How does a currency in Japan break my tech stocks?
According to Mike, everyone was borrowing cheap yen to buy expensive US stocks. When the yen got expensive, they had to sell the stocks to pay back the loans.
It's the ultimate example of how interconnected and fragile the system has become under the surface.
So the mindless robot just got a very expensive wake-up call.
Mike and Adam discussed how top-heavy the market is. The top 10 stocks are now 35% of the S&P 500.
Mike Greene points out that this is the highest concentration we've seen since the Great Depression.
Wait, 35% in just 10 companies? That's not a diversified index. That's a concentrated bet.
Exactly his point. When the robot buys the index, it's forced to pile more and more money into these same 10 giants.
But Mike warns that if those 10 companies stumble, there is no one left to catch the fall.
So if the big guys sneeze, the whole market gets pneumonia.
What's Mike's outlook for the near future? It sounds pretty grim.
Mike Greene suggests that if passive flows actually turn negative, meaning more people are selling their 401ks than buying, we could see a 20 to 30% drop.
30%? That would wipe out years of gains in a heartbeat.
It could happen quickly because there aren't enough active managers left to provide a bid.
It's like a crowded theater with a very small exit door. Once everyone runs, things get crushed.
Note to self, find the nearest exit before the movie ends.
Does Mike think the Fed can save us this time?
He mentioned to Adam that the Fed might be forced into a massive 50 basis point cut in September just to keep the wheels on.
Wait, isn't a big rate cut usually a good thing for stocks?
Not if they're doing it because the economy is screaming in pain. Mike argues that by the time they cut, the damage is often done.
According to Mike, the lag effect of previous hikes is finally hitting the consumer, and the Fed is playing catch-up.
So it's like slamming on the brakes after you've already hit the guardrail.
So how do we track this? Mike Greene gave some very specific advice.
He recommends watching the weekly jobless claims very closely. If that number keeps ticking up, the hard landing becomes much more likely.
So if the jobs report looks bad, the mindless robot starts to panic.
Exactly. Unemployment is the primary driver of people stopping their 401k contributions.
Mike also suggested keeping a close eye on the VIX, or the fear index.
When volatility spikes like it did recently, it forces the robots to sell to manage their risk.
So the robot is programmed to sell when things get scary. That sounds like the opposite of buy low, sell high.
It is. But that's how the math works. If you're watching the VIX, you're watching the robot's panic meter.
Great. I'll just be over here with my popcorn watching the panic meter then.
Today we're breaking down how David Greene and Rob Abasolo are finding massive returns in markets that 99% of investors are completely ignoring.
The core insight here is that while everyone is fighting over the same 5 cities, David and Rob are using the BRRRR method to recycle capital in overlooked areas.
Wait, what's a BRRRR? It sounds like a cold winter morning, not a real estate strategy.
It stands for buy, rehab, rent, refinance, and repeat. It's basically the secret code for growing a portfolio with $0 left in the deal.
Exactly. While we focus on that, we'll also tease their upcoming warning about the refinance trap that's catching people off guard later in the video. David Greene points out that the competition is so high in major hubs that margins are razor thin, often under 5%.
But in overlooked markets, Rob Abasolo finds properties where the cash-on-cash return can hit 15 to 20%.
Wait, 15%? My savings account gives me like 0.5. Why isn't everyone doing this?
Because they're scared of small towns or boring markets. They want the prestige of a big city, even if it loses money.
David's logic is simple. Cash flow doesn't care about the zip code's popularity.
Fair enough. Money is money, whether it's from New York or a town I can't pronounce.
The magic number Rob Abasolo talks about is the 75% loan-to-value refinance.
Right? If you buy a house for $100,000 and fix it up so it's worth $200,000, the bank gives you $150,000 back.
Hold on. The bank just hands you a check for 50 grand more than you spent.
Precisely. That's how you get your original investment back, plus extra to buy the next one.
David Greene emphasizes that this infinite return is only possible if your rehab adds enough forced equity. Now,
So I'm basically printing money with houses. Got it.
you can't just paint a wall and expect a miracle. Rob suggests spending $20,000 to $40,000 on high-impact renovations.
Think kitchens and bathrooms. Those are the rooms that actually move the needle on an appraisal.
So I should skip the gold-plated doorknobs and stick to the basics.
Exactly. David Greene warns against over-improving for the neighborhood. You want the best house on the block, not the best house in the state.
It's about ROI, not ego.
Good, because my budget for gold doorknobs was $0 anyway.
David Greene is the king of out-of-state investing. He says your team is your most valuable asset.
You need a core 4, a deal finder, a lender, a contractor, and a property manager.
Wait, how do I know the contractor isn't just taking my money and sitting on a beach?
That's why Rob Abasolo stresses the importance of daily video updates and milestone-based payments.
If you don't manage the manager manages your bank account into the ground.
So trust, but verify with a FaceTime call. Simple enough.
David Greene predicts that we won't see those 3% rates again anytime soon. We're looking at 6 to 7.5%.
And that changes the BRRRR math. You need deeper discounts on the buy side to make the refinance work.
7%. That sounds expensive. Does the strategy still work?
Rob Abasolo argues it works better because it scares off the amateur investors who only knew how to make money when debt was free.
The refinance trap is only a trap if you didn't buy the house right to begin with.
So less competition for the pros? I like those odds.
David expects a 10% increase in inventory in these smaller markets as sellers finally realize the peak is over.
10% more houses to pick from. That's huge.
It is, but Rob notes that quality is the issue. A lot of this inventory will be distressed, which is perfect for a BRRRR.
If it has a hole in the roof and smells like wet dog, David Greene says that's the smell of money.
Note to self, buy a better mask for my next walkthrough.
The takeaway from David and Rob is clear. Start analyzing 10 properties every single day in Tier 2 cities.
Don't look for the perfect house, look for the perfect numbers.
10 a day? That sounds like a lot of homework.
It's the only way to recognize a deal when it finally hits the market. You need the reps.
And before you drop a dime, David Greene insists you have your lender and agent ready to move.
So I build the team, find the smelly house, and use the bank's money to do it again.
That's the David Greene and Rob Abasolo playbook. Good luck.
I'm off to find some Tier 2 cities and a very strong mask.
First up is Joseph Wang, who argues that interest rates are going to stay high since inflation isn't going anywhere.
Exactly. Joseph believes that the recent hikes set a new ceiling, meaning we shouldn't expect to drop rates anytime soon. The baseline is higher for longer.
So if I'm to take out a loan, I better prepare for some hefty payments for the foreseeable future.
Right, that's his point. expect increased borrowing costs. Mike Greene's thesis suggests that we're seeing the end of the passive investing era.
He argues that with heightened volatility in markets, passive strategies will falter. Investors will need to be more active and adaptive.
So, basically, I can't just sit back and let the algorithm do the work anymore.
Correct. It's going to require more vigilance from investors. Nick Gerli sees a major reset in the housing market, suggesting builders are in a state of panic.
He points out that higher rates combined with falling demand could lead to serious challenges for construction and residential investments.
So if I'm looking to buy a house, should I hold off until the dust settles?
That's his advice. Wait for a clearer picture. Jeff Snider's perspective is that the global economy is flashing warning signs, mostly stemming from Europe.
He emphasizes that we're not just facing inflation domestically, but a synchronized global slowdown may be on the horizon. Right?
So, not only do I need to watch local markets, but I should also keep an eye on Europe.
Absolutely. It's a global puzzle. Interestingly, all our experts share a consensus on one crucial point. Liquidity is a major concern.
Yes, Joseph sees liquidity issues from the rate hikes, while Mike warns about how passive funds are built on stable liquidity.
So can we say liquidity is like the lifeblood of both the housing and stock markets?
Precisely, and all four have their eyes on it. Both Joseph and Jeff emphasize the interconnectedness of global markets.
Right. They argue that what happens overseas affects our interest rates and economic decisions here.
So it's like a ripple effect. Something happens in Europe, and I feel it here.
Exactly. That's why these insights are critical. Nick and Mike both stress the need for flexibility in investment strategies.
For sure, Mike argues passive strategies won't hold up, and Nick highlights the need for builders to adapt quickly.
Wait, so both think staying nimble is key? Okay, that makes sense.
Absolutely. Being reactive to changing conditions is crucial. On to a point of contention. Joseph is pretty firm that interest rates will hold steady for quite some time.
But Mike, contrastingly, believes that rising market volatility could force accelerated rate changes.
So one's saying calm seas, and the other prepare for storms. Wow, that's a big difference.
Exactly. This divergence is key for any investor strategy. Now, while Nick sees a huge reset coming in housing, Jeff takes a broader view on economic recession.
Correct. Jeff's concern is the overall global economic climate, while Nick focuses on housing-specific trends.
So it's like Nick's looking down one street while Jeff sees the whole city.
Spot on. Each has valid points depending on what you're looking at. Here's the last point of debate. Mike advocates for active management in this turbulent environment.
Yet Joseph stands by the notion that passive strategies can still come through if one times it right.
Wait, so is one saying go all in on trades, and the other sit tight and chill?
Exactly. It means different growth strategies during different times. Thanks for joining us. If you found value in these expert insights, hit that like button and subscribe for more.
This analysis is here to save you time and help steer your financial decisions.
And honestly, who doesn't want to be in the know? Like, I'm subscribing right now.
Stay with us as we bring more captivating discussions your way. See you next time.